In Part 1, we showed how Jim hedges his silver. In Part 2, we showed how that hedge can create stress when price moves violently. Now let's talk about the other side of Jim's trade, the speculator. Meet Alex. Alex does not own a warehouse full of silver. Alex does not manufacture batteries. Alex does not need physical metal. Alex trades silver futures for one reason: profit. When Jim sold 20,000 futures contracts to hedge his 100 million ounces of silver, someone had to buy them. That someone can be a speculator like Alex. Alex believes silver is going higher. He buys futures contracts at $80. He does not plan to take delivery. He does not want 5,000-ounce bars. He wants price exposure. If silver rises from $80 to $100, Alex makes the difference, $20 per ounce, on 5,000 ounces per contract. That is $100,000 per contract. That is leverage. Speculators provide liquidity. They absorb risk that commercial hedgers do not want. Without speculators, Jim could not easily hedge. There would be no one willing to take the other side of his short position. Now here is where people get emotional. Speculators are often blamed when price falls. They are blamed when price rises. But speculation itself is not manipulation. It is directional risk-taking. If too many speculators buy at the same time, price can accelerate upward. If too many sell at the same time, price can drop sharply. They amplify movement. They do not create physical silver. They do not change how many ounces exist. They trade contracts, paper exposure. Sometimes speculators are right. Sometimes they are wrong. When they are wrong in size, they get forced out. If silver collapses and Alex is long, he faces margin calls. If silver explodes higher and Alex is short, he faces margin calls. Speculators live inside volatility. Commercial hedgers try to avoid it. Now look at the full system. Jim the hedger, Alex the speculator. One wants stability. The other wants movement. Comex connects them. Hedgers transfer price risk. Speculators accept price risk. That interaction creates price discovery, not conspiracy, not magic, not secret control, just participants with different motives. Sometimes speculators drive powerful rallies. Sometimes they drive sharp sell-offs. Sometimes they get squeezed. Sometimes they create squeezes. But without them, hedging would be expensive and inefficient. And without hedgers, speculation would disconnect from the real economy. The silver market functions because both exist. Jim builds batteries. Alex trades volatility. Together, they form the futures market. That is how speculation fits into the Comex silver system. If you appreciate clear, structure-first explanations like this, subscribe to Silver Forecast. We break down silver from the inside out, from physical supply to futures structure to delivery mechanics to price behavior. No hype, just clarity. I'll see you in the next one. Not financial advice, educational purposes only.